there's a strange moment that almost no one talks about. It's the moment you check your savings account and realize there's finally something there. Not a paycheck that will disappear in 2 weeks. Not money already mentally spent. But actual savings. Maybe it's $1,000. Maybe it's 5. Maybe it's 10. The number isn't the point. What changes first isn't your lifestyle. It's your confidence. Before that moment, every unexpected expense feels like an attack. A car repair isn't an inconvenience. It's a crisis. A medical bill isn't annoying. It's destabilizing. A job loss isn't scary. It's catastrophic. When you have nothing saved, life feels sharp. Every bill has teeth. Every decision feels heavier than it should. You don't negotiate from strength. You negotiate from fear. You say yes to things you shouldn't. You tolerate situations you dislike. You stay quiet when you want to speak. Because in the back of your mind, there's one constant thought. I can't afford to mess this up. That sentence controls more lives than people realize. When your savings are near zero, your brain operates in survival mode. Survival mode doesn't think long term. It doesn't optimize. It doesn't take strategic risks. It protects. It reacts. It avoids loss at all costs. And that state of mind quietly shapes your entire financial trajectory. You might have talent. You might have ambition. You might even have opportunity. But without a financial cushion, your decisions are constrained. Not by reality, by fear. Now here's where it gets interesting. The shift between having $1,000 saved and having $50,000 saved is not just numerical. It's psychological. At $1,000 you feel relief. At $50,000 you feel control. Those are two completely different internal states. Relief is temporary. Control is structural. When you have a small cushion, you breathe easier. But you're still cautious. Still reactive. Still aware that one bad month could undo progress. You still think in terms of, can I afford this? But when your savings grow large enough to cover months, or even years of expenses, something deeper changes. Your posture changes. Your tone changes. Your tolerance changes. You stop making decisions from immediate pressure. And you start making them from strategy. That's the real confidence gap. It's not about being rich. It's about not being fragile. Fragility is expensive. When you're financially fragile, you overvalue short-term security and undervalue long-term positioning. You stay in jobs too long. You avoid investing because volatility feels threatening. You turn down opportunities that require temporary discomfort. Not because they're bad decisions, but because you can't emotionally absorb the downside. Savings change that, but not in the way most people think. Money in the bank is not just purchasing power. It's psychological insulation. It reduces the emotional charge behind your choices. Imagine two people with the same salary. Same job, same city, same expenses. One has $1,000 saved. The other has $50,000. On paper, they look identical. In reality, they are living completely different lives. One is calculating constantly. The other is evaluating strategically. One asks, what if this goes wrong? The other asks, what's the upside? And that difference compounds over time more than any interest rate ever could. Because confidence influences action, and action shapes outcome. The person with deeper reserves negotiates differently. They ask for the raise. They explore the new role. They invest through downturns. They wait for better opportunities instead of grabbing the first available escape. They're not braver. They're buffered. That buffer creates mental space. And mental space creates better decisions. Here's something most people misunderstand. The first $1,000 you save feels monumental because it's proof. Proof that you can delay gratification. Proof that you can control spending. Proof that you're not completely at the mercy of your paycheck. It builds identity. You start to see yourself as someone who saves. But that identity is still fragile. One emergency can erase it. One bad month can reset progress. And when that happens, many people internalize the setback. They don't think, that was an expense. They think, I'm bad with money. This is where most people stall. They hit a small milestone, feel temporary relief, then slip back into survival patterns. The real transformation happens later, and almost no one talks about it. Because it's quieter, it's slower, and it's less dramatic. But it's infinitely more powerful. Somewhere between stability and abundance, something subtle happens. You stop obsessing over every transaction. You stop checking your account balance before buying groceries. You stop timing bills around payday. That constant low-grade anxiety fades. And when it fades, your cognitive bandwidth expands. Most people underestimate how much mental energy scarcity consumes. When your savings are low, your brain is always running background calculations. Can I afford this? What if something breaks? What if I lose this job? What if next month is worse? Even when nothing is wrong, your mind prepares for impact. That anticipation is exhausting. It narrows your thinking. It makes you conservative in ways that feel responsible, but often limit growth. When your reserves grow, the noise quiets, and that silence changes your risk tolerance. This is where the real divergence begins. Let's talk about risk. Not reckless risk, not gambling, strategic risk. The kind that leads to higher income, better roles, smarter investments. People often assume confidence comes from personality. It doesn't. It comes from optionality. When you have $50,000 saved, you have options. You can walk away. You can wait. You can say no. That ability to walk away is more powerful than any negotiation tactic. Employers sense it. Clients sense it. Even you sense it. When you know you're not trapped, you act differently. Your voice steadies. Your standards rise. You're less likely to accept unfair terms because you're not cornered. Contrast that with someone who has almost nothing saved. Even if they're skilled, they operate from urgency. Urgency leaks into decisions. They accept lower pay. They compromise faster. They tolerate instability. Not because they lack intelligence, because they lack runway. Runway is what savings really buy you. Time. Time to think, time to search, time to recover, time to position yourself properly. And time is the hidden multiplier in financial life. Here's another shift that happens at higher savings levels. Volatility stops feeling like danger and starts feeling like opportunity. When markets drop and you're financially fragile, your instinct is to protect what little you have. You pull back, you freeze, or you panic. But when you have substantial reserves, downturns feel different. You're not worried about rent. You're not worried about groceries. You're not worried about keeping the lights on. So, your brain is free to ask a different question. Is this a discount? That single question separates defensive money behavior from strategic money behavior. Confidence doesn't mean you're fearless. It means temporary loss doesn't threaten your survival. And that distinction is everything. Think about career moves, switching industries, starting a small business, taking a pay cut for long-term upside, relocating for better opportunities. All of these require a bridge period, a gap between where you are and where you want to be. Without savings, that gap feels like a cliff. With savings, it feels like a calculated transition. The same action, completely different emotional weight. Now let's address something important. $50,000 is not magic. For some people, the number might be lower. For others, much higher. The exact amount depends on lifestyle, obligations, cost of living. But the pattern is consistent. As your reserves cover more months of expenses, your behavior changes. At 1 month covered, you feel safer. At 3 months, you feel stable. At 6 months, you feel resilient. At 12 months, you feel powerful. Not powerful in a flashy way. Powerful in a quiet internal way. Because when you're calm, you think better. When you think better, you choose better. When you choose better, your financial trajectory improves. Savings increase your emotional capacity. They widen your window of tolerance. They reduce the stakes of short-term setbacks. They allow you to zoom out. Savings buy you that endurance. They don't just protect you from emergencies. They protect you from impulsive reactions. And impulsive reactions are expensive, very expensive. When your confidence is low, you chase certainty. When your confidence is high, you pursue probability. Certainty feels safe. Probability creates growth. And the bridge between the two is capital. Not to show off, not to impress anyone, but to stabilize your internal state. Because your internal state drives your external results far more than spreadsheets ever will. There's another layer to this confidence gap that most people never consciously notice. Your standards change. When your savings are low, your standards quietly shrink. You tolerate subscriptions you don't value because canceling feels small compared to bigger worries. You tolerate relationships that drain you because conflict feels risky. You tolerate jobs that underpay you because searching feels dangerous. Low reserves create low leverage, and low leverage creates quiet compromises. But when your savings grow, you begin to reassess everything. Not dramatically, subtly. You start asking, is this worth my time? You begin to measure decisions not just by cost, but by alignment. That shift from survival-based filtering to value-based filtering is massive. Because once you stop protecting the minimum, you start building the optimal. Here's something counterintuitive. More savings can actually make you more patient. And patience is misunderstood in financial conversations. People think patience means waiting passively. It doesn't. It means refusing to move unless the move is strategic. When you don't need immediate relief, you don't grab the first solution that appears. You wait for the right one. You negotiate harder. You compare more carefully. You're willing to walk away. Walking away is a luxury, and it's a luxury funded by reserves. Think about investing again. The biggest returns often go to those who can hold through uncertainty. But holding requires emotional stability. And emotional stability is easier when your basic needs are covered many times over. Without that cushion, every dip feels personal. Every red number feels like a verdict. With a cushion, volatility becomes noise. And when something becomes noise, it stops controlling you. There's also a social component to this gap. When you're financially fragile, conversations about money feel threatening. You avoid them. You deflect them. You downplay them. But when your position strengthens, you're more open. You're willing to discuss compensation. You're willing to compare offers. You're willing to seek advice. Confidence increases transparency, and transparency often leads to better information. Better information leads to better positioning. Another subtle shift happens in how you think about time. When savings are minimal, your planning horizon is short. You think in weeks, maybe months. When savings are substantial, your planning horizon stretches. You think in years. You ask different questions. Instead of, "Can I afford this now?" you ask, "Will this matter in 5 years?" That question filters out a huge amount of noise. Short-term thinking amplifies trivial problems. Long-term thinking shrinks them. As your savings increase, your stress decreases. As stress decreases, your impulse spending often decreases. As impulse spending decreases, your savings accelerate. That loop is powerful. But the reverse is also true. Low savings increase stress. Stress increases impulsive decisions. Impulsive decisions reduce savings. Breaking that loop requires reaching a threshold, a number where the fear softens enough for rational thinking to dominate. Below the threshold, money controls your mood. Above the threshold, you control your money. And that inversion is transformative. Let's talk about identity again. When you consistently maintain a large buffer, you begin to internalize a new self-image. You're no longer someone trying to catch up. You're someone protecting and allocating. That difference changes how you approach income. Instead of chasing every opportunity, you evaluate fit. Instead of reacting to headlines, you follow a plan. Instead of copying others, you refine your own system. You become less reactive to comparison. Because comparison loses power when you feel secure. This is why visible wealth and real confidence are not always aligned. Security is internal, and internal security changes behavior quietly. And no is one of the most profitable words in finance. No to bad investments. No to lifestyle inflation. No to social pressure. No to unnecessary risk. There's a reason the jump from 1,000 to 50,000 feels larger than the jump from 50,000 to 100,000. The first jump changes survival dynamics. The second jump enhances stability. But the survival to stability shift is the most dramatic. Because survival thinking is binary. Safe or unsafe. Win or lose. Enough or not enough. Stability thinking is strategic. Optimize or improve. Allocate or rebalance. Adjust or maintain. Different vocabulary. Different psychology. Different outcomes over time. And once you experience stability, it becomes addictive. Not in a flashy way. In a peaceful way. You realize that the greatest luxury is not luxury goods. It's optionality. And optionality is funded by reserves. There's a misconception that building larger savings will make you overly cautious. That you'll become conservative. That you'll avoid risk. But often the opposite happens. When you're undercapitalized, you cling to safety because you can't afford instability. When you're well capitalized, you can selectively embrace risk because you can afford recovery. Recovery is the hidden variable. Every meaningful opportunity carries uncertainty. A new job might not work out. A business idea might stall. An investment might drop before it rises. If failure equals disaster, you won't move. If failure equals inconvenience, you will. Savings convert potential disasters into manageable inconveniences. And that changes everything. Think about how differently you'd approach life if you knew you could survive 12 months without income. Not comfortably, not lavishly, but safely. How would that affect your negotiations? How would that affect your boundaries? How would that affect your ambition? You wouldn't become reckless. You'd become deliberate. Deliberate is powerful. Desperation rushes. Deliberation chooses. This is where the confidence gap widens dramatically. At low savings levels, urgency dominates. You feel pressure to act quickly, to accept quickly, to decide quickly. Quick decisions are sometimes necessary, but when they're driven by fear, they're rarely optimal. At higher savings levels, urgency fades. You can let opportunities mature. You can do deeper research. You can sleep on decisions. That extra thinking time improves quality, and quality compounds. There's also an emotional neutrality that develops. When you have very little saved, money feels charged. Every gain feels euphoric. Every loss feels painful. That emotional volatility mirrors your financial volatility. As your reserves grow, money becomes quieter. It's still important, but it's less dramatic. You stop chasing the high of a good month. You stop spiraling over a bad one. Consistency replaces intensity. And consistency builds wealth more reliably than bursts of excitement ever will. Let's look at career confidence again from another angle. When you don't need your current job to survive immediately, your relationship to it changes. You're still professional. You still perform. But you're not psychologically dependent. That independence is visible. You're more likely to challenge inefficient processes, more likely to propose improvements, more likely to request compensation aligned with your value. And if those requests are denied, you're less afraid to explore alternatives. Fear of loss keeps many people small. Savings reduce that fear. Not completely, but enough to act. Another overlooked benefit is how savings affect your learning capacity. When you're constantly worried about bills, your cognitive load is high. Stress narrows focus to immediate threats. This limits creativity. It limits big picture thinking. When your baseline security increases, your mind opens. You think about systems. You think about scalability. You think about how to design your life instead of just maintaining it. That design mindset is rare, and it's usually built on a foundation of stability. Let's address something practical. Many people chase higher income before building reserves. They upgrade apartments. They upgrade cars. They upgrade lifestyles. But without upgrading their buffer, they upgrade their fragility. A higher income with no savings is a larger engine without brakes. It feels powerful until something unexpected happens. Then the crash is harder. Real financial strength is not visible in lifestyle. It's visible in resilience. How many months could you operate without panic? How many mistakes could you survive? How many experiments could you attempt? Those questions matter more than salary. This is why the gap between 1,000 and 50,000 saved is not linear. It's exponential in psychological effect. The first 1,000 proves discipline. The next 10,000 builds stability. The next 20,000 builds resilience. Beyond that, you start building autonomy. Autonomy is different from wealth. Wealth is accumulation. Autonomy is freedom of action. You can be wealthy and still feel trapped if your lifestyle consumes everything. But you cannot feel autonomous without reserves. Autonomy changes how you wake up in the morning. You're less reactive, less rushed, less defensive. That calmness radiates into every financial decision. And calm decisions outperform anxious ones over long periods. There's also a compounding trust factor. As you see your savings grow steadily, you trust yourself more. You trust your system. You trust your ability to manage volatility. Self-trust reduces the urge to copy others. You're less tempted by hype, less influenced by headlines, less reactive to social media narratives, because you're anchored. Anchors prevent drift. Drift is expensive. Without an anchor, people chase trends, they overtrade, they overspend, they overextend. With an anchor, you adjust thoughtfully. You don't abandon your strategy at the first sign of discomfort. That steadiness is rare. And it's quietly funded by savings. So when people ask why someone with significant reserves seems calmer, more decisive, more strategic, the answer isn't personality. It's insulation. Insulation from urgency. Insulation from panic. Insulation from short-term noise. And once you experience that insulation, going back feels unbearable. Not because you need luxury, but because you've tasted stability. And stability changes your standards permanently. Now here's the part most people don't expect. The confidence gap is not about reaching a specific number. It's about crossing a psychological threshold where money stops being a constant threat. That threshold is different for everyone, but the pattern is universal. Below it, money dominates your attention. Above it, money becomes a tool. Tools don't control you. They serve you. And when money becomes a tool instead of a threat, you stop chasing quick wins. You stop fearing short-term losses. You start thinking in systems. Systems are boring, but systems build freedom. A savings system, an investment system, a spending framework, a risk tolerance that's thought through, not emotionally reactive. When your reserves are deep enough, you stop asking, how much can I make this month? And start asking, how strong is my structure? Structure outperforms hustle in the long run. Because hustle relies on energy, structure relies on design. Energy fluctuates, design endures. There's also something else that happens at higher savings levels. You decouple identity from income. When you're living paycheck to paycheck, income feels like identity. A raise feels like validation. A loss feels like failure. But when you have substantial reserves, income becomes input. Important, yes, but not defining. That separation reduces emotional volatility dramatically. You're less reactive to external evaluation, less desperate for approval, less likely to inflate your lifestyle to signal success. Because your confidence isn't coming from display, it's coming from depth. Depth is invisible. No one sees your emergency fund. No one sees your runway. No one sees your ability to survive 12 months without panic. But you feel it. The irony is that the people who feel the most stable often look the most ordinary. They're not broadcasting wealth. They're not making dramatic moves. They're making steady ones. And steady moves, compounded over years, create extraordinary outcomes. So if you're early in this process, don't underestimate the first milestones. The first 1,000 matters. It proves you can interrupt consumption. The first 10,000 matters. It proves you can build momentum. But understand that the true transformation comes later, when your reserves are large enough that fear loosens its grip. When a bad month doesn't derail your identity. When a market drop doesn't shake your strategy. When a career shift doesn't threaten your survival. That's when confidence stops being motivational and starts being structural. Structural confidence doesn't require constant reminders. It doesn't need affirmations. It's reinforced by numbers sitting quietly in the background. Numbers that represent time. Time to recover. Time to reposition. Time to think. And thinking time is the most underappreciated financial advantage. Because the best decisions are rarely made under pressure. They're made in calm states with wide perspective. If you want to close the confidence gap in your own life, the solution isn't complicated. It's not glamorous. It's not viral. It's consistent accumulation. Not for status. Not for display. But for insulation. Build enough that your next decision isn't driven by fear. Build enough that you can wait. Build enough that you can walk away. Because the ability to walk away is the ultimate leverage. And leverage, applied patiently, changes trajectories. In the end, the difference between 1,000 and 50,000 saved is not about luxury. It's about fragility versus resilience. Reaction versus strategy. Urgency versus patience. Survival versus design. And once you cross that psychological threshold, you don't just feel richer. You think differently. You move differently. You negotiate differently. You invest differently. You live differently. That is the real confidence gap. And it has far less to do with money itself than with who you become once money stops controlling your decisions.